Imagine driving on a highway toward your destination. Suddenly, you encounter unexpected road construction blocking your path. Do you stop the journey altogether? Most likely not. You take a detour, maybe slower, maybe longer, but you still reach your destination. Trading works in much the same way. Rarely does a trade go exactly as planned. Prices move differently, news events shift momentum, and markets surprise us. The skill that separates successful traders from others is the ability to adjust trades, to take detours when necessary instead of abandoning the journey or meeting disaster head-on.
Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
Adjusting a trade means modifying an existing position in response to new information, changing market conditions, or evolving risk. It doesn't mean blindly holding on to losing trades or constantly tinkering with positions. Instead, it is a structured process of rebalancing, hedging, or reconfiguring trades to align with current realities while keeping the risk-reward balance intact. Markets are dynamic. Even the best analysis can be overturned by unexpected events like policy changes, global crises, or earnings surprises. Without adjustments, a trader risks suffering large, unnecessary losses. Adjustments serve 3 purposes. 1. Risk reduction, cutting exposure when things move against you. 2. Capital efficiency, freeing up margin or capital locked in losing positions. 3. Profit protection, preserving partial gains instead of letting them evaporate. Suppose you sold a nifty 18,000 call expecting the index to stay below that level. But the market rallies to 17,950, threatening your position. Instead of panicking, you can adjust, roll up, buy back the 18,000 call and sell a higher strike like 18,500. Add a hedge, buy a 17,900 call to cap potential losses. Convert to a spread, pair the short call with another option to turn unlimited risk into limited risk. These adjustments allow you to remain in the trade with controlled downside. Indian traders often fail because they treat trades as rigid bets. They either hold till expiry hoping for a miracle, or they exit completely, booking unnecessary losses. With high volatility in Nifty and Bank Nifty, adjustments are not a luxury, they are essential. Many experienced traders run systematic option selling strategies where adjustments, shifting strikes, hedging, or converting to spreads, are planned in advance. This discipline transforms uncertain trades into manageable strategies. 1. Scaling in or out, adding to a winning trade gradually or reducing a losing position. 2. Rolling positions, extending duration or moving to a different strike, expiry. 3. Hedging, adding offsetting positions, like buying options against short positions. 4. Switching instruments, moving from futures to options when risk rises. 5. Changing time frame, shifting from short-term trades to medium-term investments when conviction remains. Each technique requires judgment and must align with the trader's risk tolerance. Flexibility, you are not trapped by initial decisions. Improved survival, small adjustments prevent catastrophic blow-ups. Psychological comfort, having a plan B reduces stress. Compounding edge, surviving longer in markets gives compounding more time to work in your favor. 1. Over-adjusting, constantly tinkering without giving trades room to breathe. 2. Chasing losses, adjusting emotionally rather than logically, often by adding more risk. 3. Ignoring costs, frequent adjustments increase transaction costs, eating into returns. 4. No exit strategy, some traders keep adjusting endlessly instead of accepting a stop loss. Professional traders pre-plan adjustments as part of their strategy. For example, an option seller may decide in advance, if the index moves 2% against me, I will roll strikes higher and hedge with futures. A positional investor may use trailing stop losses, effectively adjusting risk as the stock rises. Algorithmic systems now automate adjustments based on volatility or price triggers, taking emotions out of the process. The advanced approach is to treat adjustments not as a reaction but as a pre-designed protocol. Adjustment requires humility. It means accepting that your initial prediction was not perfect and being willing to adapt. Many traders resist adjusting because they see it as admitting failure. In reality, it is the opposite. It is a mark of professionalism. Pilots adjust flight paths. Doctors adjust treatments, and successful traders adjust trades. The right mindset is, I can't control the market, but I can control my response to it. Consider investor A who shorted Bank Nifty options without a plan. When the market spiked, he refused to adjust, hoping the move would reverse. It didn't, and he faced heavy losses. Investor B, however, shorted the same options but pre-decided to hedge if Bank Nifty rose 2%. When the spike happened, he added protective calls, limiting his downside. While he didn't make huge profits, he survived with minimal losses and capital intact for future trades. This demonstrates that adjustments are not about turning every trade into a profit, but about staying in the game long enough to win over time. Adjusting trades means modifying positions in response to market changes. Purpose: reduce risk, preserve capital, and protect profits. Techniques: scaling, rolling, hedging, switching instruments, or changing time frame. Mistakes: over-adjusting, emotional chasing, ignoring costs, or never exiting. In India, with high volatility in Nifty and Bank Nifty, adjustments are critical for survival. The professional mindset treats adjustments as part of the plan, not as panic reactions. Review your last 5 losing trades. Could adjustments have reduced the damage? Write a checklist. If price moves X% against me, I will do Y adjustment. Practice adjusting trades in a paper trading environment to build confidence. Track transaction costs and ensure adjustments improve net outcomes. Gradually shift your mindset to see adjustments as strategy, not as failure.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.